A lot of dividend growth investors love XEI, and today we are going to find out why. Fasten your seatbelts, folks. This is going to be a good one. iShares is a very popular ETF management company in Canada. One of their more popular ETFs is the iShares S&P TSX Composite High Dividend ETF, which has that familiar ticker of XEI. This is an ETF that was designed to provide capital long-term growth while also paying out a very nice monthly dividend. In other words, it is specifically designed for total return investing. Another key aspect of this ETF is that, well, iShares wants this to be a foundational ETF or one of those circle the wagon ETFs, and we're going to find out later in this video if they have accomplished that goal. This ETF holds just over 75 of the best companies on the TSX. So when we benchmark this ETF, we do need to compare it to the TSX, and if it outperforms the TSX, then we can surely claim it is a successful ETF. However, in a recent deep dive on the Vanguard ETF VDY, a few of you commenters pointed out that this was a better ETF. So we will also put that to the test. This is going to be an exciting one for sure. Speaking of exciting, a sub to the channel would be, well, elevating. One of those things I do like to point out with newer ETFs is how it can be hard to make future predictions with a lack of history to use as a baseline. In the case of XEI, that is not an issue at all, as this ETF was created all the way back in 2011. We absolutely have a lot of history, and that's a good thing. With an ETF, we do not generally get quarterly reports, but we do have a 2023 annual report for this one that certainly has a few insights on how they did the last year. Let's take a gander at a few of them. They did see their assets under management increase in 2023 from 1.34 billion up to 1.55 billion. Funds net assets per unit also increased from $24.43 at the beginning of the year to $24.76 at the end of 2023. Those do sound great, but there is at least one negative in there. So their distributions did decrease in 2023 as they totaled $1.62 per unit compared to $3.11 in 2022. Keep in mind, we had a bear market in 2023, so that definitely explains that difference there. These are some good insights, but we really do need to dive into some numbers. And if there are numbers involved, well, that's kind of like hitting the dinner bell for the one and only Mr. Math. We always like to begin with, of course, the surface data. So at the time of recording, their current value is coming in at $24.68. They have an NAV of $24.73. Those assets under management, $1.64 billion. So we can see that they have been growing this number this year as well. If you remember, it was $1.55 billion at the end of 2023. Their volatility is just a little bit less than the market average with a beta of 0.91. And they have an average volume of 88,014. Their return on equity, that comes in at 13.11%, and they have a return on assets of 3.91%. What can I say? These numbers look pretty much as I was expecting. Nothing really standing out, and that is what I would expect for an ETF that makes that claim that it's a foundational ETF. We'll still answer that question, of course, in a little bit. So let's dive down a little deeper and check out those fund specifics. We will, of course, start with the fees on this ETF. Their management fee comes in at 0.20%. That's not too shabby. And their management expense ratio, 0.22%. So that's actually pretty good. These are low fees, and I certainly like to see that. When it comes to holdings, we already know these are going to be big companies on the TSX. And well, that's exactly what we get. Their top holding is Canadian Natural Resources, 5.18%. They have Suncor Energy with 5.13%, and Royal Bank comes in third, making up 5.06% of their portfolio. Just from looking at those three, we can clearly see that energy and financials are going to be a big part of this ETF, as they are, well, they're a big part of the TSX. When we look at that diversification breakdown, energy comes in at top 30.16%, followed by, well, financials, 30.07%. Next up is utilities at 13.86%. 5.83%. Once again, we are seeing what we have been expecting, and that's a good thing as far as I'm concerned. Let's take a look at their dividends and returns, and perhaps answer one of the questions we asked near the top of the video. So their dividend has a nice looking yield of 5.471%. It is a monthly dividend of 11.4 cents per share. Their 5-year average dividend increase comes into 5.05% per year. Well, let's look at those returns. On the 3-year, we have a return on investment of 2.53%. What about VDY? Their return on investment comes in at 5.28%. When we factor in the dividends, XEI has a total return of 17.50%. compared to VDY's 19.28%. VDY does edge out XEI on the 3-year. How about the other time frames? On the 1-year, the return on investment for XEI is 1.52%. VDY comes in at 4.40%. Factor in those dividends, we get a total return for XEI of 7.09%. Yeah, VDY wins again with 9.51%. One last chance. Let's take a look at that year to date. So XEI has a return on investment of negative 0.24%, VDY negative 0.54%. Total return after we add in those dividends, we have XEI at 2.59% and VDY at 2%. Finally, XEI does come ahead for this one. It was close for all 3 timeframes, and declaring one better than the other, well, it's kind of conditional. If you are a 100% total return investor, VDY wins the day. However, if you are a dividend-leaning total return investor or an income investor, XEI may be the better choice and the winner in your portfolio. Okay, we have enough data to pose one more question. What is my final verdict? I do like XEI, and it is a solid total return ETF. And yes, it does have some merit as a foundational circle the wagon ETF as well. I do think XEI and VDY are very similar in that sense. And as I just said a moment ago, VDY for a pure total return investor and XEI for the dividend-focused total return investor. This is an ETF without too many surprises. However, there is one, and that is how it stacks up against that TSX. You remember that benchmark I talked about earlier? The year-to-date returns on the TSX is 4.62% compared to the 2.59% of this ETF. The TSX also wins on the 1-year with a return of 8.09% compared to XEI's 7.09%. On the 3-year, we do have a different story, as the TSX returns 8.31% compared to XEI's 17.50%. This is big, but remember, that includes dividends, and the TSX benchmark does not. I do think XEI will do better when the market begins to spend more time in the green, and should move back ahead of the TSX once again. This is not a bad choice for a buy it and forget it ETF. It will do well over time, and if you were to reinvest those dividends, then it becomes a clear winner as the numbers begin to compound. If you are interested in XEI or VDY, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on, yeah, you guessed it, VDY. Thank you for watching, and I will see you in the next video.